All right, welcome back to Talk Tickers. So we've got a really interesting one for you today, Champions Oncology. Now, this is a company that came out with what looked like an absolutely fantastic earnings report, but then the stock just cratered. It's a classic beat and fade scenario, and you know we love to dig into these. So let's figure out what exactly happened here.
Okay, just look at these numbers. It's a total roller coaster. After they drop their earnings, the stock just explodes, up over 16% in after hours. You'd think everyone's popping champagne, right? Well, hold on. Because by the time the market closed the very next day, all of that was gone. Poof! And not just gone, the stock was down almost 14%. So what in the world caused that kind of reversal? That's the big question we're going to unpack.
So yeah, we're calling this the beat and the fade. First, let's look at the beat, the good news that got everyone so excited. And then we'll get into the fade, why all that optimism just evaporated.
First up, the top line, revenue. They brought in $15 million. Now, that's not just a solid number, it's more than 11% growth over last year. And maybe even more importantly, it nicely beat what the analysts were expecting, which was closer to $14.3 million. So far, so good, right? A really solid start.
And the good news just kept on coming. On the bottom line, adjusted earnings per share came in at 6 cents. Now you got to understand, Wall Street was basically expecting them to break even, a big fat zero. So 6 cents is a huge beat. I mean, on the surface, this all looks incredibly positive.
Okay, let's put it all together here. You can see the revenue beat, you can see that awesome EPS beat, but look at that gross margin. Man, it jumped from 45% all the way up to 52% compared to last year. That's a huge deal. It means their core business is getting way more profitable. So you're looking at all this and thinking, why on earth did the stock get hammered? To figure that out, we have to listen to what management had to say.
Right, so let's get into management's growth story. During the earnings call, they were, of course, painting a very rosy picture of the future. They laid out this whole long-term strategy, and we're going to break down exactly what their plan is.
Basically, their whole strategy came down to 3 key things for the year. Number 1, keep that revenue growing year over year. Simple enough. Number 2, pour money into what they see as strategic high-growth areas, specifically their data platforms. And number 3, and this is a big one, do all that while being smart with their money. They promised they'd end the year with positive adjusted EBITDA and, crucially, without having to issue new shares. That's the story they were trying to sell.
And a really big piece of this growth story revolves around this quote. They're talking about radiolabeling, which is this super specialized high-tech work. And the key takeaway here is that Champions is one of the very few labs that's even approved to do it. Management is basically saying, hey, we've got this unique capability that's in high demand. Bringing it in-house means new customers and, you guessed it, much better margins. That's a killer combo.
Okay, so the headline numbers looked great, management's story sounds fantastic, but you know there's always a but. This is where we need to take a closer look at the costs. Because once you start digging into the expenses, a very different picture starts to emerge. This is what likely spooked investors.
And here's the first big red flag. Operating expenses jumped by about $2 million from last year. Now, to be fair, you can see where the money's going. It's into R&D for that data platform. It's for hiring leadership. It's strategic stuff. But here's the thing. A $2 million jump is pretty hefty when your total revenue is $15 million. That spending has a direct, and I mean direct, impact on cash.
Which brings us to the really critical number. Negative $1.9 million. That's how much cash they burned from their operations this quarter. So even though they beat on those adjusted profit numbers, they were actually losing cash. And for investors, seeing rising costs combined with negative cash flow, well, that's a massive red flag.
And to make things even more complicated, there's this investment overhang from their subsidiary, Corelia. Look, the plan is to get outside funding for it, like from venture capitalists, but management admitted that until they land that deal, all of Corelia's costs are going to stay on Champion's books, and that could last all the way through fiscal 2027. That's a long, uncertain drag on their financials.
So now we're starting to see the real tension here, right? You've got management talking about their amazing long-term vision, but investors are looking at the here and now and seeing a company that's burning through cash. And this whole conflict really bubbled to the surface when it came time for the analysts to ask questions.
Yeah, this question from Matt Hewitt at Craig-Hallum really just hits the nail on the head. He's asking, how quickly can you translate that into getting back to that recurring double-digit revenue growth? He's basically saying, look, this quarter was nice, but we're not going to get excited about a one-time pop. Show us that you can get back to sustainable growth. That's what the market needs to see. And there you have it.
That's the fundamental disconnect right there. You've got management talking about these big, long-term strategic investments in data and radiolabeling, but investors, they're laser focused on the near term. They're saying, show us the cash, prove to us that this growth is for real, and then maybe we'll get on board with your long-term vision. So, with all that on the table, what's our take on the next call? You've got some really strong results, but also some very legitimate concerns. So what do we think is next for Champions Oncology? Let's get into our analysis.
Okay, our rating is market perform. So what does that mean? It means we don't think you should be shorting this stock, but we're also not convinced it's going to crush the market anytime soon. It's basically a wait-and-see situation until they can answer some of these big questions.
So here's our thesis in a nutshell. You have a really compelling turnaround story here, but it's being weighed down by all this investment spending and a market that needs to be convinced. The things that could change the story, the catalysts, are pretty clear. First, they need to get that Corelia subsidiary funded. Second, they have to prove that awesome gross margin wasn't a fluke. And third, they absolutely have to get back to positive operating cash flow. Until one of those things happens, we think the stock is just going to trade sideways, pretty much stuck in a range. So, how might you play this? Here's a trade idea. This is for the patient investor. You could go long the stock because you believe in the long-term story, but at the same time, sell some out-of-the-money covered calls against it. For anyone not familiar, this just means you're selling someone else the right to buy your stock at a higher price down the road. Why do this? Because you collect cash, a premium for selling that call. It's a way to generate some income while you wait for the main story to play out. Now, what's the catch? The risk is that if some huge positive news drops, say they get that Corelia funding, your upside is capped. The stock could rocket past your call price. It's a balanced approach, really, for someone who likes the company but understands it might take a while.
And of course, we have to say it, this is for informational purposes only. This is not financial advice.